Hey everyone, my name is Justin Beasley. I am one of the owners of Local Realtor Group, but I'm not a licensed realtor. I actually do investing. I develop some, help coach our clients along. So if you've not met me, hopefully you and I get to meet one day. I had the joy of interviewing Matt Tatum today. He is a cost segregation accountant. And maybe you've heard or seen the TikToks and YouTubes and, all these people get on and talk about how, they don't pay any in taxes because they're real estate investors. And maybe you've thought to yourself like, well, that's just for the big dogs, right? It's just for the Donald Trumps of real estate investing, the little fish like me, the everyday investor, that's not true for us. Well, not so fast, right? Matt Tatum is agreed to do an interview so you can learn about cost segregation studies and taking really one of the first steps in that strategy and efficiently using your money and mitigating your taxes to have more to invest and to do it in the right way and to do it in a wise way. And we had a wonderful interview today going through all those details. So if you've wondered how people do it, and how does the government incentivize you to do it? Well, you get to find out today, all right? So I hope you enjoy our interview with Matt Tatum. All right, Matt, thanks for tuning in today and joining in with us. And I want to take you a minute, just give you a chance to introduce yourself to our group of people and kind of your real estate investing journey, because you are a real estate investor, and what you do with Cost Segregation Studies and why you are an expert in Cost Seg Studies. So take a minute if you don't mind and kind of share your journey and a little bit about what you do with everybody, please.
Sounds good. Thank you, Justin. It's a great opportunity to be here. My name is Matt Tatum, and I got my start as a CPA. Ended up working in an apartment industry as a CPA, and from there got familiar with real estate, and then decided to become an investor in short-term rentals, and went from there into doing cost segregation on my own rentals because I was a CPA and knew about it and knew about the advantages of it. So through that, I also gained an opportunity to work for cost segregation for a cost segregation company, Cost Segregation Services Incorporated, and just working with them and reaching out to find clients and share the benefits of cost segregation with those customers as well.
Very cool. Yeah. So how many properties do you own?
So we were involved with different partners on 4 properties now in the short-term space in the Smoky Mountains.
Awesome. All doing well? Like what size? 2 bedrooms, 4 bedrooms, or what's your favorite?
Yeah. I do tend to like the smaller ones. I just think that's a more interesting group and kind of I don't know, just less chaos, I guess. But but it's always fun. We have a nice spread now. We have cabins that sleep 4, 6, 8, and 10.
Yep, that's awesome. Very cool. When did you start investing in the Smokies? What year?
So we got started right in 2020 in the Smokies, and we actually went live, I believe, the day that they announced the pandemic.
Wow. So you went live with your first listing then. So you had 2 months of probably nothing right after you bought it.
Well, it was really interesting. We had a lot of bookings, come in as you're new, and then we had a lot of cancellations come in. But then we were able to just jump right back in and get rebooked again. So, it wasn't really a bad time for us.
Awesome. Yeah, that's great. Well, a couple of questions. We want to talk about cost segregation studies, which has been on a lot of people's minds. Most of our new investors through our local realty group, most of them don't even know what they are, let alone how to utilize them. And then when you find out about them, I think oftentimes like your first conversation may be with family at like Thanksgiving, right? And they'll feel, you'll hear opinions about it like, well, I don't think that's right? Like, I don't know that you can count that against your taxes or, and then you're just more confused on it, and you don't even know where to get started or what it is, or is it going to cause you to get audited, and is it legal? I think all these questions people have. So the first question, and we asked our investors, not all of them, but we asked a crew of investors of ours we talk a lot with, just kind of some questions they had about Cost Seg Studies. And they sent back the basic ones and some more advanced ones. But the first one's the big one, right? Like, what is a cost segregation study?
Yeah. Cost segregation study is a way to basically take advantage of accelerated depreciation. What we want to do is reclassify a lot of that real property that gets put on the 27.5 or 39-year schedule. We want to reclassify that as personal property. And I know in the cabin space, it usually ends up being in the 5-year and 15-year property.
Yeah, absolutely. Yeah. So if someone does a cost segregation study and gets accelerated or bonus depreciation, I guess that'd be the same terms. Those are interchangeable?
Yeah, they're interchangeable. I guess accelerated would be any kind of more rapid depreciation.
Yeah.
But bonus depreciation is specifically the kind of the big one-time hit.
Gotcha. I see the difference there. Yeah. So I think, the main question I would have, and I did, just so everybody knows, I don't always send questions out, but this is a different topic, and it's very interesting doing cost seg kind of conversation today, because there's changes around what we're talking about. And it can get very complex depending on, I guess, somebody's situation or what their strategy is. So I did send you some, but I didn't send you all, because as I started to think about it, I thought, well, I've got some questions, right, that I think everybody would like to know. And the big one being, like, what does a cost segregation study, how much money is it going to save me, and how is it going to save me money, right? So, like, if I own a cabin in the Smokies that's worth $800,000 or $1 million, and I do a cost segregation study, how is it going to make me or save me any money? How does that work?
Yeah, kind of the rule of thumb, and it's definitely an estimation, but we're usually able to segregate about 20% of your building cost. So if you're talking about a $1 million property, we're going to take out 20% for land, because we can't depreciate land. So that leaves us with $800,000. We take 20% of that, so we're probably looking at about $160,000. That would be an estimation of accelerated depreciation for you. Now, right. That's your new expense. So if you only made $160,000 that year, and that was your new expense, you've effectively netted zero income. So that right there tells you the benefit already.
Can everybody count that right against their taxes, right? So if you have $160,000 and you made if you had $160,000 accelerated depreciation, and you had a W-2 income of $160,000, so for every person, does that just take your taxable income to zero?
Not exactly. Okay. Of course, the IRS gives you all kinds of rules there. When you bring in W-2s and other income, it does get a little bit trickier.
Right.
There's different rules to it, but if you're a real estate professional, that's a big one. That you can still use all of those losses. If you're not a real estate professional, you can be limited by some income limits.
So real estate professionals can take, if it's 160 and 160, they'd have a taxable income of zero if you qualify as a real estate professional. Yeah.
If those were the correct factors. Mm-hmm.
Okay. Yeah. Which I have a different conversation for a different day. That's a good one for me, because we own a real estate firm. I'm a real estate developer and investor. Our whole lives are real estate, so we qualify. Mm-hmm. But I've been told, right, when I talked to my personal accountant, she was like, when we first met her, she didn't know anything. We were just getting our company started. And she was like, hey, you don't want to say you qualify unless you 100% qualify. Like, make sure that you actually qualify before you take advantage of those benefits, So, you want to make sure you do, but that's a pretty big deal. That, I guess, if you qualify as a real estate professional, you can count 100% of it against your income.
Definitely, Justin. Yeah. And I would say, you mentioned questions people have and worried about audit flags. I don't work for the IRS, but I would not say that cost segregation is an audit flag. I would
Yeah.
say claiming real estate professional is an audit flag. So I would watch that one.
I'm assuming an audit, by the way. So personally, I was real worried about it on the front end. Like, okay, I'm going to claim real estate professional because I am. We meet the criteria without a doubt. As a family, meet the criteria. And then you're investing, and then it's like, okay. And I've heard this might not be true, but I've heard a cost segregation study adds about 100 pages to your tax return.
I haven't found that to be true myself, but but I know that there's so many ways to do things, and just depends on who's doing it, I guess.
I've never looked at them. I'm a pretty trustworthy guy, so it's like, I need to, whatever, and you kind of move on. But so I got to a point as our company started growing and what I was doing personally, and then claiming real estate professional, that not doing something that the government is giving me an incentive to do in fear of an audit was kind of crazy, because I'm probably going to get audited at some point. So it's like, I don't want to not take advantage of it. I figure it's coming. I would much rather abide by the rules, make sure my documents are in order, so that when that knock comes on my door, I can just turn it over and show them that we did everything the right way. And, and hopefully they don't charge me anymore. I kind of assume, it's just kind of off topic, or really off topic, but I kind of assume that if they knock on my door, they got to make a certain amount of money. So that's also one of my thoughts in my mind.
True. There might be an incentive there.
Yeah. So it is what it is. Right. But
yeah, and that's a great thing, working with, CSSI that I consult with, we, do provide full audit support.
Very cool.
We provide all the documentation that gives you exactly what you need for the tax return.
Yeah, awesome. So do you know, and you may not, I know you deal with tax stuff off the top of your head, but income limits for people who aren't real estate professionals, do you have I think most people would probably fall under $200,000. So if you have less than $200,000 and you're not, that's in taxable income, and you're not a real estate professional, how much of your accelerated depreciation can you count against your income?
Yeah. It's passive activity loss rules is what it's classified under, and I believe that you can only claim $25,000 as a loss in each year if you make up to $150,000. So after that, it decreases. They take some of your benefits away. But the great thing about these losses is that they will stay. You can carry them forward and use them whenever you need to.
Is there a limit on how far forward you can take them?
Not really. I mean, it's probably a 20-year limit or something like that. So nobody really worries about it.
Yeah. Okay. So other question, not that we hadn't talked about before, which, can you stack them? So if I had 4 cost segregation studies and I'm not a real estate professional, I know can I roll all of those forward? So I got 4 different studies this year, a max of 25,000, and I've got 25,000 stored up for the next 10 years. So is that?
Yeah. I mean, really, it all flows through. It's really, the expense is really just the opposite of the income, right? The income is going to come through to you, and it's going to get reported. Well, it's the same way with the expense. If it ends up being a loss, it's just going to come through and get reported and saved for future years.
That makes sense.
Yeah,
that makes sense. Yeah, this has been probably my favorite strategy. Like as I got started and I look back at my personal journey, for me, like I never worried about taxes, and it's not good advice, by the way. What I mean by that is I always paid my taxes, but I never operated worrying about what my taxes were going to be, because I didn't make enough in a 12-month period to really worry about it. I was much more concerned about like getting better in real estate and numbers in the market and developing and investing, and just figured, hey, if I'm making good money, I'll pay my taxes and whatever. That all begins to change once like larger tax bills become part of your life, and you're like, okay, now I can't acquire an asset because I've got to pay the government. And you hear all of these stories about how people have mitigated a lot of their taxes legally, and you think, well, how are they doing it? I mean, what's the play that is legal and allowed, and this is it. I mean, this is kind of the play. And
I would say cost segregation and the 1031 exchange, those are the two things, and it's amazing how little the public and even some CPAs know about it.
Yeah, absolutely. Explain how cost segregation studies. Explain how 1031s can and what's in my mind. Like there's a depreciation. I think it's called a depreciation tax. You have to pay once you sell.
Yeah,
recapture that.
depreciation
Once you sell
recapture.
it, yeah. And you can basically defer that to the next property through a 1031 exchange. Did I say that correctly?
Yes, you can do cost segregation and 1031 exchange together. A 1031 exchange, basically you're moving your old numbers, your cost of the property, your depreciation of the property, you're moving that to the next property, and avoiding, handling that gain and paying on that. So again, there's, I'm sure pages of rules on it, but the depreciation recapture comes in, but can be deferred as well.
Yeah, awesome. All right, so like the ins and outs of cost seg studies, like how long does a cost segregation study take on average, and what do they cost?
Well, we can get a cost segregation study done for you in about 6 weeks, and that's from the time that we gather all the right information. We ask for, of course, all your purchase documents, any kind of cost you have, any kind of blueprints. We actually included in our fees are travel costs for us to come and take pictures of your property. And we're just looking for, anything that we can claim for you. Basically, we're going to have it go through our engineering team, and, they're going to be looking for all of those personal property pieces that they can separate.
Right.
So yeah, it usually takes about 6 weeks. In my experience, the cabins have been around $5,000. And so if we go back to our estimated depreciation expense, we're talking about paying $5,000 for a $160,000 expense.
Right.
It always adds up for me.
Yeah, it's a pretty great deal, right? I mean, especially if it moves you down tax brackets. For real estate professionals, like we said earlier, it's just a no-brainer.
Yeah.
But even while you are scaling your real estate investments to the point where you could qualify for that one day, for a lot of our investors, that's the goal. They got their W-2 jobs, but they're investing with the goal of one day just being able to leave that job and basically own properties. And while you're moving in that direction, it's still a wonderful tool to move down tax brackets and to mitigate a lot of your taxable income, which is
That's
great.
Right. Yeah, it makes it even more powerful for investors because of that time value of money.
Yeah,
you want the money now, and you want to invest it now. Just based on those principles, you make a lot less if you wait and invest it later.
Yes. Gosh, that gets me. You're going to get me going a thousand directions, because this is a conversation I have a lot with different people. I have it with family. I have it with friends, other investors. It's funny, like if I showed you my taxes, if I just laid them out, and of course you have like your quarterly taxes for businesses and self-employed individuals or whatever, but I also defer taxes. Anything the government allows me to defer, and I don't know if this is great advice, but I'm just giving an insight to my own story here, okay? If they allow me to defer it, I defer it. And people will ask, especially my mother who hates that. She's like, it's just crazy. It's terrifying, Why do you do that? And I tell her, it's like, because if deferring $5,000 in taxes allows me to acquire one more asset, the money I'm going to make on that asset, instead of giving it to the government, is far better. So I would rather, I don't want to pay extra fees, but as self-employed individuals, they will let you defer. Oftentimes, I think it's not an accountant, but I think it's like 25 or 50% of what you're due can be paid in additional deferred payments with no fees if reported on time and everything else. And anytime they let me do it, I do that. Terrifies my mom, but I want the money so that I can take the money and invest it and make money on that money, because the government's never made me a dime. They've never made me a penny. And so yeah, that's my personal. You talk about that time value kind of deal there and how this works. That's a big one for me, because I just figure the more of my money I get to keep, the more I get to invest, and the better I can do with it.
Yeah. It all comes down to the math.
Yeah. Yeah. Let me give you a scenario, and this is one that's happening more and more. And at least it's happening in my life because we build and we develop some. But we'll have a buyer on a property, so it's a cabin we built or whatnot. And afterwards, they'll say, hey, I'm doing a cost segregation study. Do you have X, Y, and Z? Well, I don't want to give that to them because, to be just very forthcoming and honest, I don't want them to know how little we built that cabin for. And not that all cabins are built the same or they're built cheap, but when you start to turn or build, to give you an idea, we may build 40 this year or in 2023. When you start to build a certain amount,
sure,
we have business deals that drive the cost of those things down. You have partnerships. You have a lot of different things that go into that to help mitigate expenses so that we can do that. We don't want to give those exact figures to the buyer because they'll feel like they overpaid.
Yeah.
When they don't understand, like after the sale, after you close, there's additional expenses that you're not going to see on that sheet. So we've denied them access to that because they didn't buy an under construction cabin. They bought a finished cabin that was just 2 days old. So for an investor who buys a new cabin but can't get access to certain specific information, does that negatively affect their cost segregation study, or does that just require more time for you all to figure out what can be depreciated?
No, I would say it helps them really, because what they want is we need the cost of the items,
right?
And and I'm sure through your records and through what they paid, I guess we could figure it out, what they paid for different, add a markup to everything and what they paid for every item.
Yes.
But really, I think it would benefit them to just use their purchase price and kind of work backwards from there.
Yeah. Gosh, that makes sense, right? Because if we go buy, I hadn't thought about that before, but if we go buy 200 windows to go over X number of cabins to get a discount on those windows, you don't want that discounted number. You want the market number on that window to be able to appreciate it, so. That's
right. Yeah. Your tax return is always going to reflect your cost of an asset.
Right.
So if you got a great deal, that's great, but that's going to be reflected in your basis.
Yep, absolutely. All right. So the deeper questions, those are kind of ins and outs, what they are, how much a cost seg, cost, the time, what you might save, how it works on your taxes. But in my understanding, there are some changes that are approaching for, I believe, both accelerated and bonus depreciation. Some negative changes for the real estate investor, right? So, again, when I first started, I didn't worry about it. I'd heard about the bonus depreciation, but I didn't make enough money to care about it. And I was just solely focused on trying to do what I needed to do to get where I wanted to go. And now I care a lot, right? I think back to when that was on the news, thinking like I had no clue how big of a deal that was. But 2023 starts a phase out schedule for accelerated, from what I've seen called bonus depreciation.
Yeah.
So for bonus depreciation, and so it leaves me with a lot of questions because now I'm worried, right? Am I on a clock to be able to take advantage of these benefits? And after 2026, am I going to have any, deductions at all? So I wrote down to keep my thoughts focused on this. With the current phase-out schedule, what happens to cost segregation studies, or what impact does it have after 2026? And just for people watching who may not know, it's basically going down at starting 2023, 20% a year of what you can take down to zero after 2026. So what effect is that going to have on cost seg studies? My assumption is a great effect, but I may not be wrong.
Yeah. It basically just changes the timing of those expenses. So and we'll use the correct title, I guess, is 100% bonus depreciation. So 100% bonus depreciation is typically made up of your 5-year and 15-year property, in the cabin space at least. And as you said, 23, it's going to go down to 80% and then 60%, so forth. And that's the plan. We know that the lawmakers tend to just change their minds sometimes. So we'll see how that goes. But what that means is that if you have property in that 5-year category, it's now going to actually be depreciated over 5 years. Now, again, when we're talking about cabins, 5 years is better than 39 years.
Right.
But you're not going to get as
the
much.
year one. Is that what you're talking about?
Mm-hmm.
So even after 2026, you can do a cost segregation study and push the depreciation to the first 5 years.
That's right. Mm-hmm.
But you won't have any like big 150,000 in year one. You would have 800,000 over 5 years.
That's right. That's right.
Oh,
yeah.
Great.
Yeah, it's not bad. It's not bad. Our current cost segregation graph basically is a high number in the first year and then just drops straight off and is level, for the rest of your 39 years.
Right.
If everything phases completely out, then we're going to see more of a 5-year line. We're going to drop down to a 15-year line, so the next 10 years, and then we'll drop down to the rest of your 39. So you're always going to have an advantage there. It's just going to be a little more stepped.
So basically, to go back to go through the numbers, I want to make sure in my mind it's right and I don't say anything wrong, lead people down a dark path here.
Yeah.
So take the $1 million property, say the land was 200,000, you've got 800,000 in depreciation. With the current rules with 2022, on average, that's $160,000, just as for a rough figure in bonus or bonus depreciation.
Yeah.
As a real estate professional, I could count all of that in year one. But after 2026, if they can end up completely phasing it out, I have to take that 160 over 5 years, but not the other 640. Is that right?
Yeah, and the 160 in our example was the 5-year and the 15-year. So it depends on how that breaks out.
What determines if it's a 5 or 15 years? Is that something you determine?
That's based on the type of property.
Okay.
Yeah.
Excellent.
So a lot of your like cabinets and that kind of stuff is 5 years. Your driveways are going to be like 15 years. So just different categories.
Yeah, your roof will be 15 years, I guess.
Well, the roof actually will stay with the 39-year schedule.
Oh, okay.
Yeah, so that's more of a permanent asset, a piece of the property. Yeah.
Yeah. Wow. I'm learning a lot right here, right? So
it's all based on a reasonable life.
Yeah.
Of the asset.
This is why you need someone who knows what they're doing to do your cost segregation studies. Because I had the roof, I have everything as early as I could justify it going. Right. There's so many rules I'd break in the process of it. Trying to get that on the front end. Well, that's great. That's great information. So still very valuable. I mean, the principle's the same, the timeline's different. You're trying to get as much of that 39-year depreciation front loaded, similar in my mind to how a bank front loads a mortgage loan. They front load the interest into a mortgage loan. You're trying to front load your depreciation to the front, to as much as you can to the front end of your ownership of that property, so that when you sell it in 5, 7, 10, 12 years, you can 1031 it. You've been able to capture all that depreciation on the front end, and you still able to do that.
Yeah. I guess if we're talking about dream scenarios, you would want to get a few properties started now. And then when bonus depreciation does go away, if that happens,
right,
you hopefully have more properties that you can, like you said, stack them up and still create greater expenses that way.
Yeah. Okay. Has there ever been a time that you're aware of where they tried to phase out bonus depreciation and ended up changing their mind? Or is this the first time they've tried to do this?
As far as I know, it's the first time they tried to do this, because we talk about the phase out, but really it was the Tax Cuts and Jobs Act that brought it in to begin with. So it was really an addition to our rules to begin with.
Gotcha.
And now it's just phasing out.
Phasing out. Okay, I see what you're saying. So we're just going back to normal, basically.
Basically, yeah.
Yeah. Okay. That makes a lot of sense, because when you read that, if you're not knowledgeable in what we're talking about, I literally thought like, do I have to just take everything over 39 years? So it's very good to know there's some things that are 5, some that are 15, and some that are 39 over the life of that property. So that's excellent information. If we want to file, this is right from one of our clients that they had a really good question. They said, if we want to file taxes by the April deadline, when should we have the cost segregation accountant start?
Yeah, our company deadline is going to be around the middle of February.
Okay.
So that means it's about 8 weeks before. So, like we said, we have the 6-week time span for a project. And so we're just adding a couple weeks there to get it in the door.
Yeah. So it may be a little different, but if you're in by February with you all, then you'll be able to take it by April. Very cool. Quick question about that, right? Does that mean, and I've got some assumptions with this, but I've learned so much that I'm learning there may be ways to navigate through this. We are at December, right before Christmas, December 20th or whatever today is, maybe 20. What is today? 27th?
21st.
21st? I was bouncing all around it. 21st, right before Christmas. If I go under contract on a property that closes in January, but I've yet to file my taxes, do I have to claim that property that closed in January on 2023, or can I file it with 2022?
Oh, now you're trying to get me in trouble with all the with all the nuances.
You don't have to answer, I guess. I mean,
No. I will say there are, of course, tons of rules.
Yeah.
And we always figure them out, but I'm not the guy that just says, "Hey, I memorized everything." Right? That's not how it really works. But you do not have to do a cost segregation study before the end of the year. Okay. That's another thing that even people that are in cost segregation will try to tell you, and really it's a sales pitch. You just have to be done by your tax return.
Yeah, it just have to be done by your tax return.
And even if you extend your tax return, you can still get a cost segregation study in, down to October or whatever when you extended it.
Yeah. For the question about the closing, that's probably a very gray area that's up to I would imagine it's up to you and your accountant to be comfortable with how you're reporting that at the end of the day.
Well, the trick is the property does have to be placed in service in 22.
So if you bought a short-term rental and didn't close it till January, then you cannot. You've got to have it
active in 22 at least.
Well, that answers that. Yeah. Yeah. Great. Is it possible, and you kind of hinted at this earlier, and not to get like overly political, but is it possible that they will do away with this phase out schedule? Elections change, the world changes, and maybe they get inflation under control. Who knows, right? I got all these things, and maybe the jobless rate goes down, and they're like, you know what, we don't want to do away with this. It's been a good benefit for a lot of people, and we want to encourage people to buy real estate again and invest in it. So we're going to stop phasing this out. Is that a possibility, or do you think it's just very likely this is the way it currently is? It's just going back to normal after 2026, and we just have to get used to that?
Yeah, I'll leave it with anything's possible. That's what I would say.
Yep.
I'm fairly confident that most of these politicians are involved in real estate as well. So
I know.
I'll say anything's possible. Anything's possible. Yeah.
What I know is if one of them knocks on my door for a vote, the first question I'm going to ask them, which has changed over the years, is how do you feel about the phase out schedule of bonus depreciation?
It's a good plan. I like that plan.
That's going to be my big question right there. So people are like, so you're a one question voter. I am until 2026. No, until
that's right.
That's right. What's your advice? After 2026, and you're a real estate investor, you're a cost segregation accountant, you got a lot of experience, you've done well with your properties, you got in 2020, which wasn't before the boom, which is interesting, right? You were actually doing well with your properties, and you bought when the market was very hot. So I guess the way I'm going to ask this is I'm going to ask it a little personal, but what are your plans going forward for real estate investing and cost segregation studies? Because there's part of me that thinks, okay, if they're phasing some of that down, and it's just going back to normal, but man, if I've got the capital to acquire an asset, I need to do that while bonus depreciation is still at the highest available mark to me. Is that how you're approaching it, or kind of what's your strategy with everything going on in the economy and moving forward?
Yeah, I think the smart strategy is really just to play with the rules that we're given.
Yeah.
So yeah, if real estate continues to be supported through legislation the way it has been, then we need to take advantage of that.
Yep.
Um, and and it's nothing bad that we're doing. We're just going by what we're given.
Yep.
And hopefully through that we can find the means to help others
Right.
and make a difference.
Yep. I mean, it's no different than somebody at the end of the day going out and taking a client to lunch and keeping their receipt and counting it as a deduction. I mean,
Yeah,
it's the same effect at the end of the day for a real estate professional, and then even for other investors, based off of their income threshold there. And once you realize that the government incentivizes you to do these things, that's why they're phasing it out. Now they're wanting to phase it out and go back to the normal way, and maybe it comes back again one day, or maybe they stop it. But
sure.
it's a legitimate thing, and if you do buy property between December 21st and December 31st, 2026, you need to be taking advantage of bonus depreciation. And then what I've learned today, which has been very good for me, is that even if the phase out schedule happens, you still are going to need to do cost segregation studies to take advantage of the 5-year marks and the 15-year marks, and to get as much as that pushed forward as available to you.
Yeah, yes, and we're still talking about next year being 80%.
Right.
So
Right.
we're only talking about that remaining 20% being pushed back out over the 5 or 15.
Yeah.
So yeah, there's still advantages to be had.
That's right. And by the time you're done investing by the end of 2026, hopefully you're financially free and you're spending your weekends in the Keys on a boat doing something fun. All right. You can
That's
do
right.
a lot. You bought 4 properties in 2020. We still got a lot of years left before the end of 2026. And even then, it's still going to be very advantageous to buy real estate, do cost seg studies, 1031 your properties, develop a good game plan for how you leave your inheritance to your family
That's
one
right.
day after you're gone. So, yeah. Well, Matt, if you don't mind, last question, probably the most important question I've got for you. How do people find you? How do they get in contact with you? Shoot out your email or any place else you want people to get connected with you about cost seg studies.
Yeah, definitely. To check out the CSSI website, it is cssistudy.com.
Yep.
And that can just show you, what the company has done. The company has completed more than 30,000 of these studies. This is based on any business property, so it can be a long-term rental all the way up to commercial warehousing, just whatever, any kind of business property, just not your personal home, And by email, you can reach me at mattatumcpa@gmail.com, mattatumcpa@gmail.com. And by phone, of course, text is great, 423-299-5734.
Awesome. And if you are, depending on where you're watching this or hearing this, if you're seeing in the email, Matt's information will be in the email. If you're watching on YouTube, we'll put it in the description. So wherever you're at right now, you'll be able to get in contact with him. We'll make sure that's available to you, and he'll be happy, I'm sure, to do a cost seg study or 2 or 10, whatever you need done. So, Matt, thank you for your time.
Thank you, Justin. It was great to be here.